Good evening, everyone. Once again, most welcome to this webinar today. We'll be talking about understanding the volatility, the volatile nature of the markets, and we'll be understanding how to tackle this volatility, which are the best strategies to work with as of the current market status. My name is Yogesh. I have worked with Century from last 8 years. I have done a lot of training sessions, seminars, webinars, and my profile is basically to interact with the clients, understand their risk profile, and on the basis of that, uh, try to draft a portfolio, train them about the software, train them how to buy and sell in the market, conduct training sessions on regular basis as well to keep them updated how the market is performing. And this is something which Century has lived on that vision to provide continuous awareness and education about the financial markets. Because as we all know, the nature of the market is extremely risky and it will be very wrong to neglect that part. So today we'll be talking about understanding the volatile nature. And before we start, on behalf of Century Financial team and myself, would like to thank um, everyone who is from the medical or the healthcare area, the first responders, the doctors, midwives, nurses. If you have any of your friends or colleagues who are working in the medical field, on behalf of my team and myself, thank you very much. You have been risking out your life for us, and that is something which is really commendable. I wish a great health to all of you out there. This is a tough time as in pandemic for all of us, and I am sure that a lot of offices are already open and most of you are working. So once again, thank you so much for taking out time and joining this webinar. I'll try to make it much more interactive, although we know that I'm the one who will be doing the talking. But as you can see, that there's a chat option available, and you can easily send me any questions if you have any kind of queries. If you have, I would try to answer you while we are doing the session, or once the session is over, I'll be able to take all these questions as well. Just keep writing these questions. I'll take these questions as we progress, right? And please, if somebody is not able to hear me now, or if the connection is not getting established properly, don't worry about it. The copy of this webinar will be uploaded on our YouTube channel. So you can subscribe Century's YouTube channel, and you can view all these kind of webinars which we had in the past, Investor Education Week, which we had in the past, and gain knowledge and understanding from there, right? So as we said, today we are going to talk about volatility. And before we talk about volatility, obviously one thing which we really have to understand, the nature of the markets is extremely risky. And please understand this. Everything what I'll be talking here will be talking about the global outlook on euro, dollar, gold, S&P 500. We'll be talking about a few stocks as well, which, looking at the trend, could be a decent opportunity. And we'll be looking about also at some trading strategies. We'll look at how to identify breakouts, patterns. So there will be a lot of information, but please understand this, that everything which I'll be telling you, every investor has a different risk appetite. So I would suggest you that please do not take any of these as a recommendations or as a suggestion to buy or sell. This is a market information, and I hope that the message is loud and clear. Please do your own research before you take any of the trades or you use any of these strategies. And do not take a loan, do not borrow money to invest into financial markets or for day trading. This can be incredibly risky. You can lose your capital, you can lose more than you have deposited. These are leveraged products. So please be very careful. Now, a part of the volatility. So when we talk about volatility, friends, I will be conducting a poll as well to understand your investment criteria. But when we talk about volatility, is it's like a term which is used to describe changes in an instrument. Like for example, any instrument whose price changes are showing volatility, like for example, we can see the prices moving up and down really fast, right? There is actually a symbol, there is an index which can measure volatility, also what we call as volatility index or VIX. And it is one of the most popular measure of volatility of the stock markets, fear and greed, basically. So what we have to understand is when we talk about volatility, it means prices moving up and down really fast. uh, can volatility be a good opportunity? It can, but as we know that every opportunity will come with both risk and reward. So the key points which we have to understand about market volatility is, first, when the markets are fluctuating up and down, buyers and sellers, they both have the opportunity to make profit, and in a shorter amount of time, because they're moving up and down really fast, so you get more and more opportunity to trade and to enter and exit. But with increased opportunity to profit, it also carries the increased risk. And we'll further and further in this presentation, we'll talk about how increased volatility can also lead to a higher amount of risk. So that's why you have to make sure that when you're trading in volatile markets, you have to have some risk control measures like stop losses. You have to make sure that when markets are volatile, you have your risk management tools right there. You can calculate your losses. Also, we have seen that certain trading strategies, when we are talking about short-term trading strategies in shorter time frames, looking at 1 hour chart, 2 hour chart, 3 hour chart, can be more effective in volatile markets. So when you're measuring risk and reward, you will be looking at, okay, if I'm looking at a shorter duration price movement, let's say if I want to trade in gold, and I will see that in last 2 days, hour on hour basis, like every 1 hour, how much the gold prices has moved. If in 1 hour gold moves this much, but over the whole day it moves this much, then as you can see that there is a better chance of you trading in a short term market, because the range is pretty much confined. It's not too long, right? But if the range is too high, then you might have to wait longer to close your trade or to enter into the trade. So sometimes we have seen this shorter trading in shorter time frames, especially in volatile markets, can be a really effective way to trade. Now, what I'll also do is I have switched on to my live trading platform as well. So what we'll do is we will keep, going back to the platform and trying to understand from the charts, if how to identify breakouts, how to identify resistance and supports as well. So it's going to be one of those sessions. We will also talk about, as I said, uh, few steps to understand that how to measure volatility, or basically how to understand volatility and use it for a better trading opportunity. So before I start, I'm just putting one poll over here, and all of you are free to vote. And please, I must warn you, look at all the options before you give the answer. So results will be displayed by the end of the poll. I'm just publishing this. So which asset class you would like to trade or invest in? Just look at all the options first. I'm talking about stocks, commodities, cryptos, index. Index means Sensex or Nifty, Dow Jones, S&P. Real estate, you're aware about. Forex means the currency pairs, mutual funds or exchange traded funds for that matter, art, painting, or diversify in all asset classes. Again, guys, obviously there is no right and wrong answer subjectively, but this is just an idea. And whatever you like to do, please answer the same question, because it's very important for me to know that what kind of preference you have as an investor, and I'll explain you both the areas that why you should invest into each amount of asset class and what are the risks involved in it. A lot of you are going forward for stocks. Nobody has so far put commodities, or so commodities, guys. Commodities are your gold, oil, silver, rice, wheat, sugar. Everything is a commodity. Cryptocurrencies are your bitcoins. Again, a very very risky instrument. Index, mutual funds, forex. Okay, so I think by now most of you have. I'm just going to give 8-10 more seconds before I end this poll, and we'll keep doing this. We'll keep having more polls to understand that which are the what are the criteria to which we normally invest. Okay, somebody. Okay, right now I'm going to end the poll and results will be with you. Okay, I see more people now. Go on, go on. I'll just give 5 more seconds to this. Okay, okay. Good that I did not end this poll before. I see more people coming in, more people joining in, voting for this. Okay, last 10 seconds. 9, 8, 7, 6, 5, 4, 3, 2, 1. End this poll now. Again, I hope you all can see the result. The result is 44% out of the total crowd said it'll be you'd like to trade or invest into stocks. Not bad. 11% of you suggested commodities. Good. 11% real estate. Mutual fund 22%. Diversify 11%. Best thing I like about this poll, and the best thing I love about this poll, not the poll, the results actually. Nobody has opted for cryptocurrencies. Brilliant. Cryptocurrencies like Bitcoin, Stellar, Litecoin, Ethereum, cryptocurrencies do not have much fundamentals or technicals to work on. Like, for example, if I'm talking about Forex, which by the way, 0% has switched for Forex, which is also one of the most highly volatile, dangerous asset classes, right? So it's a good thing. Most of you are looking forward for diversification, mutual funds, ETFs, real estate, commodities, stocks. Most of you majorly have suggested stocks to be on the higher side. I have not included one asset class over here, which is bonds. I'm sure if I would put bonds, that would be one more asset class which people would like to invest into. And we'll look into later. We'll have another poll where we will see what will be the ideal portfolio for stocks and bonds. So what we are trying to understand is the asset class which is much more riskier. Many of you refrain from that particular asset class, or maybe it's the fear of the unknown. It's always there. So that's why you have to be very careful. Even this can be very well your portfolio also, by the way. Your 20% funds can go to mutual funds, some of them can go to commodities, some of them can go to stocks as well. There is a stock index like Dow Jones S&P 500, which sometimes investors they invest, sometimes they don't. So clearly most of you are inclined towards shares and commodities. Now what we'll do is we'll try to understand how volatility plays its role and what are the important things we should keep in mind. Now, as we know, we have seen the key points. We understood that higher volatility, higher fluctuations can lead to better opportunities, but also a higher amount of risk as well. Now, we need to understand which are these 4 steps where we can understand the volatility and we take advantage of these volatile markets. At least that's the attempt to take advantage of the volatile markets. And please, as I said, keep asking me if you have any questions in mind, keep writing the questions. I may answer now, I may answer later, but at least that will be something which will be in mind and we can always talk about it. Now, the very first step to understand volatility for the betterment of your trades, a steady aim and a very solid defense. Now, it looks like it sounds pretty childish. I'm not saying that you must have never heard this before. I mean, there are every time when you talk to a financial advisor or even when you start looking, it's like a normal handbook which says that your defense should be really, really solid. You should have a risk threshold which should be which is like a discipline and that should be followed. uh, why this is something which is very common and everybody says it? Because very few investors they actually practice it. It is like one of those things that you should not say bad things about people. Everybody keeps saying this, but not everybody follows. That's why when somebody tells you, you should not talk bad about someone, this is something which you have heard from everyone. But why people keep saying this again and again? Because not everybody follows it. Now, when we are talking about the very first step to take advantage of the volatility, the it is starts right from the basic. You should have a steady aim, should have a solid defense. First thing, you should be comfortable in understanding the fact that volatility is high. Over the past 3 months, I have talked to a lot of people, and some of them had invested in stocks. And when markets went down by almost 40%, 50%, they invested, and then again it went up, and then again it came down. So the most important part was when it came down, there were a lot of investors who entered into the market, and then it went up, but they did not book their profits. They waited for the markets to go higher because the news was there that the entire world is reopening, which is also happening. So maybe the stocks will go up, but then the stocks started coming down again, right? So when that happened, all those people who were in profit, they saw a 10-15% decline again, and they got panicked that why this is happening. So you have to understand that when volatility is high, this is something which is really normal, and you have to be comfortable with it. If you're not comfortable with the volatility, what will happen? You will get panicked, and that's not the solution for any problem. Being panicked is something which you should not do in any situation, not trading, not in your personal life, not in your professional life, anywhere. So you should be comfortable that it's a high volatile market, and I will witness high prices going up and prices going low in a very short period of time. You should recognize there is a potential for significant loss of capital and are prepared for the risk. See, friends, blaming your financial advisor or your mutual fund manager or your trading guide, anyone, it will not bring your money back or it will make profit for you. It's your money. You will have to get involved. Everybody can give you ideas, insights, research, updates, but at the end of the day, it's your money and you have to manage your risk. People can always update you about the market, but nobody is there to take the blame for this because these are markets. So you have to recognize that you're putting this capital. If this is something which is for your child's education and you want to trade forex with it, it's a bad idea. You might make money, you might lose money, but if you lose money, then that's your child's education fund. So always weigh in what are you risking against what. If you need this money by the end of 2 months or 3 months, don't invest into a market which is volatile. It just doesn't work this way. So you have to be very careful the kind of money which you are putting in. You need to be prepared for the risk. And one of the most important considerations is the size and the stop loss placement. Now over here, I'm going to take you to the platform to explain you how the size of the trade matters. And this is something which is, again, very common, but I'm sure it's going to make a lot of difference when I start explaining it to you. What you're looking at as is a trading platform, but I'm going to just make it very simple. See, let's take example of gold. I'll search gold here. Click on gold, commodity to maximize this chart. Okay. Now, if I see gold prices, look at the gold prices today. Now, this is your order ticket. I will open a quote panel so it is visible to everyone. Okay. Please just write a OK in the comment box if you can see this platform and if you can see the quote panel which I have opened. I will keep doing this. I will keep telling you to write text on the comment box to keep you awake and do not sleep in my session. Just send me okay if you can see this. Perfect. Okay. Most of you can see this. I can. Now the quote panel which you see, these are gold prices. Gold is measured in dollar per ounce. In Dubai, gold prices is 215 dirhams, 208 dirhams, 210 dirhams. But when you are trading in global markets, you will be looking at gold prices, which is in dollar per ounce. How much is 1 ounce? Anyone? Fastest finger first. How much is 1 ounce? Type. Search Google if that's what it takes. Fastest finger first. 1 ounce. 1 ounce is equal to how much? Come on, guys. Somebody. Take a wild guess. I'll tell you. I'll give you a hint. It is in grams. 1 ounce is how many grams? Take a wild guess. 50, 60, 40, 10, 100. Okay. Somebody searched. Okay. Okay. Getting 3 answers. 4, 5. Okay. So somebody said 20 grams. It's not 20, not 40. Okay. 10, not 10. 28. Very close. So we are talking about gold, which is ounce in troy ounce. So 31.1 is the exact answer. Somebody gave exact 31.1. Yes. So one troy ounce is around 31.1 ounces. Okay. So this price which you see for gold, this is in dollar for 1 ounce. If you're looking at, so this is what we call as 1 ounce and one troy ounce. Troy ounce would be 31 and ounce will be 28. So not much difference. So when we are looking at troy ounce, it is 31.1. And when you're looking at this price, this is dollar per ounce. Now just look at this price. You can see on the quote panel, there is a small L which is mentioned. A small L which is right here, 1761. And then there's a H which is 1779. Now this L and H means low and high, which means the lowest for gold today with what it has hit is 1761 and highest it has gone is 1780. Now that means that gold has no problem in moving at least $20 a day. What we have seen, even if you see in the last few days, $20-$25 a day, gold can easily move, which means if gold is moving $20 a day, now you have to decide something for yourself. So I have, as you can see on the right side, this is a demo account. So I have $100,000 in this demo account. Okay. Now, if I have to buy gold, let's say looking at a daily trade, and if I have to close my trade over a day, if I write 1 ounce, the amount is calculated in dollars. 1 ounce is equal to $1,768. If I write 10 ounces, $17,000. Now just understand this. If I'm buying 100 ounces, or let's say I have $100,000, I'm buying something worth 100,000. This is 56 ounces. 56 ounces if I buy, click here, 2-click process, and my order has been bought. I go to my positions, and now I can see that I have bought gold 56 ounces, on which I'm losing 14, 13. See, look at the volatility. Look at the prices moving so fast. Let me just zoom in for you guys. See, look at the volatility. Look how fast the prices are moving. Now, when I'm looking at this, I'm looking at 56 ounces. Let's take 50 ounces. If you have bought gold 50 ounces, which is worth $100,000, you are looking at $20 movement on an average, because that's what we saw today. So that means if gold goes up by $20 and if you have 50 ounces, quick answer, how much is the total profit which you made? If gold goes up by $20 in the price and you have 50 ounces, how much is your total profit? Anyone? Type fast. You have 50 ounces of gold. You bought at 1768. Let's say gold price goes to 1788. $20 up. What is your total profit in 50 ounces? You get 5 seconds. After that, I'll tell you the answer. 5, 4, 3, 2, 1. Yes. Okay, somebody sent at the last second. Okay, okay, okay. Yes. So if you have 50 ounces and gold goes up by $20, you make $1,000 profit. Somebody has said 100, but I think 10 has been missed. But the right answer is $1,000. Now, it's very simple. That means on a $100,000 account, you have the opportunity to make $1,000 profit with 50 ounces looking at the average movement of gold. $1,000 profit is 1% of 100,000. That means you have the potential to make 1%. But imagine if gold goes down by $20, you lose also 1%, right? So the point is that if gold is moving $20, now this is where you have to understand how to measure your risk. Let's say you don't want to lose $1,000 in $100,000 account, so you keep your stop loss right now. You keep your stop loss. You don't want to lose 1,000. You want to lose not more than $500. So you select a stop loss. You write 500, and then you want to book a profit for 1,000. 2:1 risk reward ratio, right? Risking $500 to make $1,000 profit. You modify, and now you have modified it. So now you have a stop loss of 500. That means if gold goes down by $10, your $500 loss is booked. You know that gold moves, what you have seen, what you have observed, that gold moves at least $20 for the day, which means if you are putting it at $10 low, there is a chance that your stop loss might get hit. But if you put a stop loss $30 down, then there is a chance that you might be safe for today. It might not hit your stop loss, might come down by $20, but then might bounce back to your take profit. But if with 50 ounces, if you keep $30 down, then you are risking around $1,500 profit. That does not match with your risk reward ratio. So what you can do also, what you can do is instead of buying 50 ounces, what if you buy, say, 25 ounces? Because if you buy 25 ounces, or let's say if you buy 10 ounces, because if you buy 10 ounces, then even if it gold goes down by $30 and hits your stop loss, you lose 300. Your threshold was still $500, right? If you are buying 20 ounces, for example, if gold goes down by $25, that's where you lose your 500. So you can always do this high and low, big position, small position, depending on how much an instrument moves. So what is the basis of this calculation? That what is the average range throughout which gold is moving? If gold is moving $20 a day, and if you're buying 100 ounces, that could be a potential profit or loss of $2,000. But same thing with the same movement, instead of 100, if you do 10 ounces, then you can keep your stop loss lower. Because in volatile markets, what happens? It might hit your stop loss, bounce back. Like that's the complaint which I hear all the time, and mostly as an excuse that why you are not putting a stop loss. A lot of clients, they tell me, Yogesh, we did not put a stop loss because it hits my stop loss and bounces back. Markets are so volatile. So if you want to keep a longer stop loss, then you have to reduce your quantity, right? So that is what I mean when I say that if you have to understand here that normally that how you should place your position. So that's what it means, that when we talk about size and stop loss placement. In a volatile market, there's a possibility that if it hits at the stop loss, it bounces back. And when I say stop loss, that means if gold is moving $20 a day and you're keeping a stop loss at the 20 or 21st dollar, it might go down and bounce back, and then you'll feel bad. So if you want to keep a longer stop loss, your trade size should be reduced so your loss is not increased. That is really important. Please do not go home and keep a high stop loss at your trade just because I told you to. No, you're keeping a higher stop loss or a longer stop loss, but your trade size should be closed. So that's how normally in a fluctuating market, you have to understand the size and your stop loss, right? Again, guys, I'm getting a lot of questions, so I'll try to answer one by one. Given that COVID rates are increasing, big time, what impact do you foresee on US stocks? It's a very, very common question, very good question, which always keeps coming. So we'll hit to a portfolio as well in the coming few slides, and we'll see a few companies which we have recently targeted and researched about. But the simple answer to this question is stocks at this point of time, and this is something which I kept it for the last to give you an outlook, but I'll tell you now, stocks are expected to be on the bullish side on a longer term. Given the reason, see, offices in UAE have started already, right? Everybody is going out. Look at India. India has one of the highest cases, but even nobody is staying at home. They're still going out. US or any other part of the world. It's a kind of a situation where people and even the governments, like in spite of Anyone? Okay, if you can hear me, please just send okay. So I'll just get an idea that you're able to hear my voice. Okay, very bad connection. Now, yes. Okay. For those, for them, okay, now it's again. See, guys, extremely sorry, connection and network issues are there. There are a lot of companies using these webinar-based platforms. A lot of webinars are happening, so this is expected. Oh, we're not able to hear for the last 10 minutes. Okay, perfect. So don't worry about it. What I'll do is I'll just repeat the question which I had answered. I'll repeat it again. It was related to the global outlook for the COVID situation. And I will again answer this question. Let's move on with the presentation. So we understood first thing by the platform that looking at the size and the stop loss placement, we have to understand the daily range of the instrument and then adjust our size accordingly and then put our stop losses accordingly. In a volatile market, it may come down and bounce back. So it might hit your stop loss and go back. So that's why you might keep a longer stop loss but reduced position, right? Next thing, we'll talk about going with the trend. Now, trend is something they keep saying this trend is your friend, trend is your friend, trend. You have to go with the trend. You cannot go against the trend. And it's fair enough because what happens is trend is like uh, it becomes a habit. Like for example, there is a chart which you can see, and you can see this is an uptrend because every time it comes down, every low you see where they have pointed out a buy, every low is higher than the previous low. Every new low, if you see, is higher than the previous low. It's a slanting curve on the upside. This is your upward trend. So your upward trend suggests that the buying should be when it comes down. So when we say trend is up, that means it's not like okay, it is going up. But trend is up means it goes up, comes down, but then again goes up, comes down, again goes up. But that trend is not broken. Now, if you see this line is not broken. And I'll take live examples of this on the chart itself. We'll look at a few short-term charts and try to understand that how do we build a trend line. But with trend, we have to understand one more thing. The key to this approach is to find a stock or any financial instrument that has been trending higher, but it has not accelerated the pace in its advance. Please do not confuse these two things. If it has already gone up and then you're buying, then you're not buying in an uptrend. Uptrend means like this, that when it comes down again and it's still within the trend, you go for a buy, right? Or when there is a range and this range has been broken, there is a breakout, then you buy upside or downside. So this is what going with the trend means. You have to watch out for the fact that when it is in the mid of progressing, that's when you should buy. Should not buy when it has already gone up, because then it might come down, then it is useless. Have to buy in the trend, and you have to be on that particular, like for example the trend for gold these days, it's on the higher side. Okay, the trend for if I say euro for example, it has been on the higher side. So you have to go with the trend, and you can check your trends using, so I'm going to take a very smaller time frame chart, as we saw in the key points that a smaller or a short term time frame charts can be helpful during the volatile markets. So I'm going back to the platform. Please look at this. Okay, so I did the transaction in gold. Now let's take something. Let's take a much more shorter duration. Let's take silver, for example. We already have gold. Let's take silver. Now this is silver chart, but you see right now each of this candle represents day on day movement. So this is slightly long term than what we were talking about. We are looking at a shorter frame chart, right? So to understand the shorter frame, instead of one day looking at a day on day movement, why not let's look an hour on hour movement. Like it is much more shorter duration when we see, and when we see hour and hour, and if we go back, let's say around 22 or 24 days behind this, just to see here that what trend could be like. So for example, if you see it here, second, price alert hit. Okay, now see, for example, look at this, hour on hour performance. Look at this. And when you zoom it, you will see that every new low is on the higher side. New low is on the higher side. New low is on the higher side. And then this trend breaks. So look at this volatility over here. Now, in a volatile market, you have to understand that every time you take a trade, why it is important. So when I told you in the beginning, that first thing which you have to understand is in every volatile market, you have to have a risk management, you have to have a stop loss. When this was going better in a shorter period time, in a shorter term time, if you see hour on hour, we have seen in a short term trend, it has broken this uptrend line and it has come down. So when the trend line, see what happens when the trend line gets broken. So if you technically what you have done, see this hour on hour. Now if I have to see this 1 hour, then again another hour, another hour, another hour, here, here. So when you see this line has been formed, every time it comes here, this point you buy. Sometimes it will work in your favor, right? But sometimes it might not. This trend gets broken, and see what happens, the impact when a trend gets broken in a volatile market, it just drops. That's why you have to keep a stop loss. That is the importance of a stop loss, because maybe 3 or 4 or 5 trades go right, but the sixth trade which might go wrong might take your entire portfolio down. So please do not take a trade without a stop loss, right? See, this is silver. We're going to take another example of a stock as well, since we were talking about the stock. Let's take example of Lyft. Everybody's I'm sure is aware about Lyft. Lyft is like Uber. It is in US when we see. Now for Lyft, we are looking at a daily chart. We talk about stocks. If you're taking a stock looking at the daily chart just to identify the trend, let's say you are going to keep this trade for 3 days or 4 days. So when we are looking at Lyft, looking at the daily chart, let's zoom a bit to understand how it looks like. If you see last 4 months and day on day practice, look at this. This is the movement of Lyft, and if I have to identify a trend, could be this, or if I were to draw it from here, even this. I think this is better here, right? Second, let me delete this. Look at this. Now, if you see Lyft here, this is your trend for the Lyft. Now it's here today. Ideally, this should be your buying level. Again, looking at a technical analysis, I'm not looking at fundamentals, not looking in pandemics, trade wars, Brexits, nothing. Looking at a very technical perspective, looks like a decent buy over here. So this is your uptrend. Okay. You will not buy Lyft when it is already reached here, or when it has already reached. You buy Lyft when it reaches around these levels, because this is the uptrend line. You buy it here, you can keep a stop loss down. If you're keeping it, so right now this price is 34, okay, or 33. If you buy it at 33 and you want to keep a stop loss at 24, then if you buy 10 shares, $10 down, you make $100 loss. If you buy 100 shares, $10 down, you make a $1,000 loss. So that way you should understand that when you are measuring the trend, when you're looking at the trend, and if you want to keep a bigger, longer stop loss, then you have to reduce your quantity. But don't go against the trend. Trend is something which is even when we see technically, trend is something which we should always keep a check on. If you're on the wrong side of the trend, whether it is a currency, commodity, or stock, you will never be able to make money. First step, identify the trend, be on the right side of the trend, and always keep a stop loss in case if there is a breakout in the trend and your trade is not protected, right? So this is something what we learn in the second step. Then comes, just one second. Then comes next. Also, since we are talking about trend, before we move on to the next step, we have been talking about the trend so far. So this is something which we have been doing this in a lot of our webinars. Week on week, trying to do research on the companies which, or the areas or the sectors which are which have the expectation to perform well during COVID. And since we're talking about the technical bit of trend, let's talk a bit about the fundamentals of the trend also. Looking at medical equipment companies and packaged food industry. So this is again something which you can look at. Now this time, normally what happens is I tell you a lot about the stock while you're able to see it. This time I'm going to make it much more easier. There's a lot of description about these stocks, and we are going to talk a bit about every company. So there was another sector of industrial and engineering as well, but since we have limited amount of time, we are going to discuss more about the current medical equipment industry and the packaged food industry as well. So there are few companies which we have pointed out this week. We are looking at Avantor, Boston Scientific, Abbott Laboratories, Mondelez International, and Post Holdings. You see the current market price. This was made on 21st or 22nd June. It's been 2 or 3 days. And for example, Boston Scientific, if you see $36 at the current market price, yearly high, 52-week high, 46, yearly low, 52-week low is 24. Out of 26 analysts, 23 of them from Bloomberg has given a buy recommendation. One of them expects that it will go down. Two of them have suggested a hold. Similarly, if you see companies like Avantor buying 6, hold 3, and if you see the current market price, it's 17, 52-week high is 19, and 52-week low is 6. So going with the trend, sometimes even from the industry point of view, we all know that medical equipments and medical healthcare industry has actually performed really well during COVID times for obvious reasons. So we are going to have a look at few of these stocks and try to understand. So first, medical equipment company is Avantor, leading global provider of mission critical products and services to customers in the life sciences and advanced technologies. Now, see, guys, we have to understand every stock will have its fundamentals, compounding annual growth. So as you can see, uh, that it shows that there is a steadily improving margins in the compounding annual growth rate. Compounding annual growth rate means uh, year on year, the growth which keeps on increasing. So if there is an increase in CAGR, that is something which is good. Similarly, if you see healthy FCF conversion of 100% driving significant deleveraging. FCF means the free cash flow. Cash flow is also something which is one of the most important factors which you have to see when you are choosing out a stock. There should be enough cash flow to support interest, to support liabilities, and to make sure that the proper debt management is there. So these kind of stocks are something which we are looking at as a leading provider of critical products and services to businesses in healthcare, education, government, biopharma, and advanced technologies, material industries. The very depth of the product and service offering and independence are its key competitive differentiators. So this is something which we are doing research on. Again, guys, as I said, please understand your risk appetite before you invest into any of these. These kind of research is prepared on the current market situations. It can go really well, it cannot go really well. So please have your risk management measures properly. Now, moving on, after Venture, we are looking at Abbott Laboratories. Now, this is one of the, again, medical equipment companies, leader in the diagnostic business, currently has a number of products that help diagnose COVID-19 and COVID-19 antibodies. Abbott will remain a key player in diagnostic, which will continue to play a significant role in early detection of health condition as well. So this is really, really important, because if this is one company which has a number of products that help diagnose COVID-19 and COVID-19 antibodies. So antibodies are really important to go ahead for a further research on. So that is something which can be really good. They have announced US approval of its next generation integrated continuous glucose monitor, Freestyle Libre 2, now for both adults and children. Compared to Abbott, market leading CGM, the long awaited offers optional real time high and low glucose alarms. Now, this particular laboratory, to make it simple for everyone, this particular laboratory is working on, and they have received the approval to go ahead with the continuous glucose monitor, which will be able to alarm you whether the glucose levels are high, low, or if they're going low, it can be easily alarmed. Now, this is something, again, in the US diabetes market, which is still under penetrated. It is something which is a very positive news. With pharma stocks, you have to understand this. Something which gets developed and gets approved by FDA opens to a new revenue stream. So that is something which you can always look forward to. There is a high volatility in medical equipment stocks also, because if the trial fails and FDA does not approve, then you might see a decline in that stock, and which we have seen numerous times in so many medical stocks. Next, we are looking at Boston Scientific. Again, it's one of the good companies which we have seen. Boston Scientific uh, engages in its development, manufacture, and marketing of medical devices that are used in interventional medical specialties. Their product portfolio is really deep, and pipeline should drive strong revenue growth. There has been cost reductions, which is very efficient, and that is something which can drive the earnings growth in a very stronger way. So that is again something which you can look. Balance sheets and debts look proper, and this is something which you can always read more about and target this company as well. Moving on, we are looking at packaged food. Mondelez International. I'm sure if you go to a supermarket, even if you do not eat packaged food, you must have seen this box. So again, packaged food industry is something which there were a lot of stocks in packaged food, and we have shortlisted these. See, Mondelez, which we can always see this particular company, they have preserved a lot of capital through this entire crisis. They are still trying to provide dividend, which is a good thing. Okay. They have ample of liquidity, about 9.5 billion of committed and mostly undrawn credit facilities at the end of 1Q. Important thing is in the second paragraph, if you see that the localized accountability should help the company recover sales momentum faster than peers, given the greater agility to respond to local market needs. So this is something which is important. So they identify consumer-led trends, local level to encourage gross profit dollar expansion, and there are higher volumes, and that is really, really important. So Mondelez International is something which also we are looking at. Next is your post holdings, again packaged food. So guys, stocks like this, again, this is something which can make a difference. This kind of portfolio can be provided to you. You can always talk to your relationship managers after the session is over. Like I always say, please talk to your RMs, get some demo accounts as well. Try to talk to them, and they will be able to provide you these portfolios. They will be able to provide you demo accounts, which you can practice on day basis, right? Moving on to the third step, watch out for the breakout. Now, watch out for the breakout means every instrument has a support and a resistance. Like for example, let's go back to the platform, and before I go, let's read this bit. Why it is important to watch for the breakout. Breakout means this was the range, right? If this range gets broken either on the higher side or on the lower side, if this range gets broken, it's a breakout. It might signal you a buy, or it might signal you a sell if the downward support level is broken. Now, why you have to watch out for the breakout in a volatile market? Because when prices are moving rapidly, an upside breakout can be followed by an immediate and substantial run to higher prices. This type of potential is the primary reason to trade breakouts in a volatile environment. And this is applicable to both sides. I'll give you now an example on the chart directly on the platform. And please keep writing more questions. I'll be able to answer this once the session ends. Now, okay, let's take, for example, say, okay, ExxonMobil, for example. I think it's one of the less volatile stocks, by the way, so I don't think it's the right example to take. Okay, let's take, rather than that, maybe Amazon. Okay, now look at this. This is one of the best examples of what happens during a volatile market, because when you're looking at, see this up. Now this was a resistance, and this was kind of support here. If you see, I can also make a channel like this. Okay, here, and then if you see this, right, this was the whole channel which was going on. The moment a breakout occurred, which is precisely over here, which was at 25.30, next thing, looking at here, 27.91. So this is, guys, again, this breakout happened on 9th of June. Today is 22nd of June. 9th June, the breakout happened 25.39, 25.40, and now you see it is 27.90. 27.90 it hit, and it has come down today at 27.30. So from 2500 to 2900, from 9 June to 24th, which means you see the how volatile this can be during once the breakout happens. This particular moment, this is the breakout. If you see over here, for example, if I have to see a breakout, look at this. It can be at multiple levels. I'm going to make another channel over here. Let's take this and this. So over here again, look, this was the resistance going on. The moment breakout happened at 2000, it went up here, 2,450, another $450 months. So the instruments, when they become volatile, when the volatility happens, you always see, and you always should watch out for the breakout sessions, because that is something which can actually quickly make gains for you. But at the same time, what I told you, please remember this, something which can make a quick gain can make a quick loss also. So that's why you should keep a check that if breakout is on the higher side, you buy when the breakout happens. It can give you a decent amount of profit. But at the same time, please, if even if the breakout happens, you keep a stop loss when you're buying it, because if it a false breakout, and that's a term, false breakout, if there's a false breakout, it might again start coming down. So okay, somebody still asking breakout still not clear. I showed you the chart. Do you want me to repeat this chart again? So breakout normally means that when there is a range going on. I'll just explain you this once again. It's important for me that you should understand this. Just 1 second. Here. Okay. Just one more time. Here I will explain it to you. Now look at this. So I'll just make a quick. Yeah, this is okay. See, over here and then over here. If you see throughout this particular channel, price came down here, then bounced back, then again went here and came down, again bounced back. You see, came down here, this level, and then again, if you see, it reached here and came down, right? And then again slightly at these levels and bounced back, and then again. Now over here it should have came down because that's what the support and resistance that was forming in, but instead it went up. So it broke this range, right? And the moment it broke this range, it just continued to go up. This is called breakout. Similarly, what we saw even in this channel also, there was a resistance which was going on. It touches here, comes down, touches here, comes down, touches here, comes down, touches here, comes down, and then eventually breaks out. But when it breaks out in a volatile market, it just goes higher. So the idea of trading is you will not trade over these levels if you're trading in volatility. Should watch out for breakouts, because if there is a breakout on the higher side, the possibility is it might quickly go up to a decent level, which in normal market conditions it may not. Right? So now I think it should be clear. We'll move on to. So we understood how the breakout works. Next, it's my presentation. Okay, now this is the last step which we should consider. Consider short-term trading strategies. Now, short-term, I told you about the time frames. I told you about how you can see instead of 1 day, instead of daily charts, you can look into 1 hour charts. Now, during the short-term trading strategies, we should always keep a check on few things. Sorry, yeah. Set a specific percentage profit target. Now, a specific percentage profit is important because it will help you to keep yourself in check. Because if you don't have a profit target in your mind, how you are going to book your profits? So for example, if you have put $20,000 in your trading account, you have taken a trade, $20,000, which means you cannot lose normally if we go by a 1% rule, you should not lose more than 1 or 2% of your total capital day on day. So if if you have $20,000, $200 or $400 is 2%. So if you are risking maximum loss of $400, you should be at least aiming to make $400 profit, right? Similarly, in a product, if you have seen gold goes up by 0.5% every day, so that should be your profit target. If you do not book profit, I have seen people losing money more when they don't book the profits they have rather than markets going down to loss. Like booking loss is one thing, but having profits and not booking it in a volatile market, the profits may not sustain because fluctuations are so high. Like what happened? This is the best example. Post COVID, when market came down, a lot of people they bought, but when it went up, a V-shaped recovery when it happened, they did not sell it. They thought it's going to go higher because markets have now recovered, world is reopening and everything. But then it came down again. So you have to set a specific percentage of your profit target because you're trading this for a short-term strategy. Second, sell part of a position at the first good profit-taking opportunity and hold the remaining position in hopes of generating additional profits. Or that, like if you're not booking your profits at all, then it doesn't make sense. But let's say that you have a considerable amount of profit and you are expecting the markets will go higher, at least book partial profits. Let's say book 50% of your profits and then wait till it goes up so where you can book your additional profits. But do not keep your trades just open. Don't think it's going to go up and do not book anything, because then you are just blocking your money for no reason. It has happened with a lot of investors of lately due to post-COVID, V-shape and W-shape recoveries. Second most important thing, I'm going to show you this one on platform. It's something which is really interesting. Use an overbought or oversold type indicator like RSI, for example, and sell when it signals that the security is overbought. Activate a trading stop loss sooner than normal end user. So this is something which is really important. Before we move on to the first section, last section of this, I'll show you on the chart what does RSI means and how it can help you out. Now, RSI, when we talk about it's a trading oscillator, it's a trading study to understand whether a stock is overbought or oversold technically. Again, not fundamentally, but technically. I'm looking at a daily chart right now, 1 year movement of Amazon, right? Now, 1 year of Amazon, how do I, if I have to enter a buy or sell on the basis of technicals, I select here technicals, I search for RSI, I click on RSI. Now, the last step says that you can use strategies like RSI to buy or short sell when and it can tell you that whether the stock is overbought or oversold for a long term or a short term. Now, this is a 1 day chart. It's a longer term we are looking at, slightly longer than a short term chart. Now, if you look at this is called RSI. What does RSI mean? To be very simple with you, this is just a graphical representation and you can see very clearly Amazon prices. This is Amazon we are looking at. So most of the time Amazon comes down. If you see this blue line I have made over here, okay, I'm just looking at the RSI right now. Now look, every time Amazon touches here, somewhere around here, it comes down. Similarly, if you look at the downside, where it goes up from, somewhat here or from the peak. Look at this. So if you go back, look at this. Look at this trend. So what does RSI tells you? Very simple rule. If RSI, any stock or any RSI stock, if it goes above 70%, which is the line which you can see, if it goes above 70%, it gets into the overbought category. It's time to sell the stock. And if it goes below 30%, it indicates that the stock has fallen down into a oversold category and it's time to buy. So in a volatile market, now this is 1 day, okay? Let's say if I would look at Amazon instead of 1 day, if I would look at a 4 hours, or let's say look at a 1 hour chart. Now 1 hour chart, if you see, it has already touched these peaks right over here and then it has come down. Let me just move this. Yeah, look at this. It went into an overbought category and then it came down from here and now it's here. So in a volatile market, wait for this price come down below 30%, and as you can see, most of the RSI, this is your standard bounce back price. Look at this. 1 second, guys. Okay, reopen it again. Okay, technicals and just putting it once again. Now this time I'm looking at a 1 hour chart. As I said, a 1 hour chart shows you this. See this. So if you see right now it's coming down and your buying price should be around here, right? Most of the time it bounces back. So okay, can you guys hear me again? I think we lost the network. Can you still hear me? Okay, I'm just gonna wait 5-10 seconds. I'll reboot this. Guys, if you can hear me, please give me a yes or no or okay. If you can hear me now. Okay, can hear me. So, guys, once again, sorry again for the network congestion. See, so I'm looking at a 1 hour RSI right now, and if you see, it is already in the middle of middle line. It has already gone into the oversold category, overbought category, and came down, and now it is inching towards that below orange line, which we can see. And if you see here, most of the time it reaches here, bounces back. So the last step says tells you simply one thing, that when it comes down, wait for the overbought or the oversold areas using RSI type indicators. There are RSI, stochastics, a lot of technical indicators, which again, anytime you have some time for one-on-one session, we can always sit and discuss, right? So this is something which you can also use when you are doing it. Now, last but not the least, we talked about trailing stop loss. Trailing stop loss is something which is really helpful. Now, activating a trailing stop loss sooner than normal. So I'll just give you a verbal idea of how a trailing stop loss work. If you buy Apple shares at $300, for example, and you have put a stop loss at 290, which means if it comes down to 290, your stop loss will get hit, and you book a loss. But imagine you bought Apple shares at 300, and now the price has gone to 310, so you are already in $10 profit. So what you can do is you can put a stop loss at 300, which is your cost. So if it goes to 320, your stop loss automatically moves to 310. So you at least get guaranteed this much amount, because if it comes down, your trailing stop loss will act like a shield. It will not come down. So this is the difference between a regular stop loss and trailing stop loss, right? So these are a few short-term trading strategies which we can always sit and discuss. Again, as I said, there are many of you who are asking for a one-on-one session. Most welcome. You just talk to your relationship managers, and we can do these one-on-one sessions. Last section, very quickly, we'll talk about the global market outlook for euro, gold, oil, and S&P 500. So those of you who missed the answer which we were talking about, I'm going to talk about this again. See, guys. Yeah. First, to start with, see, we'll talk about euro first. Now, euro, to tell you about what euro has gone through right now. Euro, the prices of euro USD, they're still going higher. Euro is still stronger as compared to dollars. Over a long term point, euro is expected to be bullish. Reason being, we are looking at a government fiscal stimulus, which I've been talking about in last few webinars. That there's a government stimulus which is supposed to be increasing the spending of government. That means an increase of supply in cash, and there will be a increase of supply of euro also in the economy. But this time, it is not a monetary stimulus by central bank. It is more like a fiscal stimulus, which is by government. So that's something which can make euro look better over a long term. Second thing is, what has happened, dollar also has acted like a safe haven. When there is a panic situation, people start investing into dollars also. So dollars as a safe haven, the demand can be now a bit reduced, given the fact that most of the countries have priced this whole lockdown fiasco, and nobody wants to go for a lockdown anymore. So dollar as a safe haven now may not be that impressive, and people would demand less dollars. So that is also one reason that why we are expecting euro to be on the higher side. Gold, most importantly, like guys, if you look at gold, I gifted some gold to my sisters last year in August. That time gold was $1,530 per ounce, and right now it is $1,775 per ounce. Today's high. Clearly, sisters are making profit, aren't they? So gold is something, guys. It has shown a very positive strength in last 1 year, and even last few months, we have seen gold prices bouncing back. Due to monetary policy, low interest rates, we expect gold prices to continue go higher and dollar to remain on the weaker side. So that is one thing which we are still expecting. Gold has also broken, reached to almost 1700-1800 levels, which is higher than compared to its previous levels. If we also see now, coming back to oil, if you see a technical chart for crude oil WTI, there is a resistance at 41 or $42. So I think that resistance is pretty tough to break. It will remain below 42. So below that could be a buying opportunity, but again, profit booking can happen at 42. Last, S&P 500. So with this, we can answer the same question which we are talking about. That what I was saying was that over a long term, we keep equities on the higher side, on the bullish side. Reason being that one reason, in Dubai, we see a lot of people. Their offices are open. In US, people do not care about the lockdown. In India, unfortunately, people have started going out. So, given the COVID rate increasing, if there is a phase two, the governments, with their stimulus and with their approach, it is not giving the vibe that there will be a lockdown 2.0, because a lot of people now are going out. They're taking more precautions. There is a lot more awareness about how to protect yourself. So that being said, equities are still on a very bullish zone itself. Yes, volatility is there, up and down, we see on day normal basis, but there's a lot of uh, uh, still a bit of positivity, given the fact that nation is reopening, the world is reopening, and even if there is an increasing COVID cases, the countries may not go over a lockdown. This is simply a choice of people's life over economy, or economy over people's life, if I were to say. So it's like each man for himself, and it's much more awareness about it, that you have to be protecting yourself and maintaining a social distance. Second thing, world interest rates are low, so the cost of cash is relatively low. Even if you keep money in the deposit box right now, you will not receive much interest. Now, when interest rates are low, investors tend to put their cash into equities even when the price earning ratios are high, which means that when I know that I'm not going to get enough interest keeping money in cash, as an investor, I would not mind buying equities even if they are overvalued. How about reduced consumption and reduced demand and supply chain? So see, once the idea is, once the world reopens, uh, if the world reopens, we will see increased demand and increased supply also. See, if you see oil prices back in April and oil prices now, there has been improvement. If you see industries, for example, if you see industries example, and now we have what we are hearing the news of, that in Beijing there is a possible lockdown because the cases have started increasing. Without any doubt, China is the backbone of manufacturing. But that being said, around the world, when we hear about economic activity and the reopening of the world, it is expected that the economic activity will start boosting up once. Take example, don't go too far. Take example of UAE. They are welcoming tourists from 7th of July. 1st of July, I think my office will also be open. So the very essence is, if the entire world is reopening and there is no lockdown, then demand and supply at some point of time, like in case of oil, I still feel that it will take a lot of time before the oil supply and the oil demand matches together, at least for the next 6 months or a year. But when it comes to regular consumption, like over here itself, malls are open, uh, even people are buying stuff, and the sales of the stores, they have started coming back. So simply, it is same thing. It's like a fighting spirit. Nobody can just leave everything and then be under lockdown. I'm seeing so many people, in spite of telling them be inside, they're still going out, but they are being much more protective. So that is something which is there, and people would prefer overvalued equities over keeping their cash in a bank, because they're not getting any deposit. Credit is cheaper because the interest rates are low. So that is again, and also index like Nasdaq. Now, index like Nasdaq has companies or components like Amazon, Apple, Microsoft. The post-COVID, these companies have performed actually well. Nasdaq has Nasdaq has components which have performed well during the COVID. Okay, most of the stocks in Nasdaq have performed well during the COVID as compared to the stocks which have not performed well during the COVID. So a majority of stocks which have performed well during the COVID, the number of those stocks is high in Nasdaq. That's why the Nasdaq has reached to a new high also in last few months, if you have seen. So these are the companies which have proved their mettle during COVID. So I think that is one reason that why we have seen Nasdaq and S&P and US market, a very quick recovery. It is volatile, which is true, and it is not wrong to think that if phase two comes and if there is another lockdown, we might see equities down. See, it is a possible scenario. So that's why, if that is one case, you carefully scrutinize your sector. Medical equipment, packaged food industry, technology. These could be the factors. If you attended last few webinars which I conducted, I put a lot of stress on recovery stocks like Southwest Airlines, right? But at the same time, I put a lot of stress on tech stocks like Dropbox or Slack Technologies or Zoom Technologies. So your portfolio should be diversified. That is one reason that why you cannot be scared of equities. You have to invest into different areas, but you have to be much more diverse, which was the first question when I asked that among all these questions, among all these asset classes, how would you like to invest? So diversification is the right way to do it. You need investment in commodities also, because gold prices have been going higher, right? Commodities, they set a pattern, and if you're on the right side of a commodity and you have a pattern, then you're at a better stage. So similarly, commodities, equities from different sectors and different industries, everything is important. So that's why you need to have a diversification. So with Century Financial, at least you need somebody who can assist you, talk to you about what is your risk profiling, because that you have to decide. Your risk profiling is your most important thing, followed by the investment horizon. For how long you want to invest. Last webinar, I discussed something called 100 minus age idea. That if you are saving money for your retirement, if you're a 30-year-old, so 100 minus 30, 70. 70% of your total portfolio should be into equities and other risky assets. 30% should be, because when you are 30 and you're keeping your money for the next 40 years, you have enough market cycles to cover if you have any losses. And equities, as compared to bonds, give you much higher returns with much higher risk. But if you have a long time for 40 years, then you can preferably put more money into stocks. And even if there's a down cycle, you have enough time to support that. So that 100 minus age recommendation is something which you can always try. And rest will always be there to support you if it is needed with trainings and webinars. You can always keep a check, right? Unless you have any more questions. If you need, guys, if you have any more questions and you need a one-on-one training with me, please let me know. It's free of cost. You can talk to your relationship managers. We can have a one-on-one session. I can explain you more about the platform, the technicals, anything which you would like to know will be really done for you. The copy of this portfolio, please talk to your relationship manager. It will be sent to you. And if you like the webinar, please review us on Google. Mention about what you liked about the webinar, or if you don't like about the webinar, please be honest, be true. Review us on Google. I hope that this webinar created a bit of difference when you started from in the beginning. Using the platform, can I purchase stocks, purchase to own for a very long term? The ownership of the stocks is available. So as Century Financial, we are introducing partners to CMC markets, FXCM, and interactive brokers. If you open the account through interactive brokers, you can have the ownership of the stock. You can buy and keep it. If you want to use leverage and derivatives, CFDs, CMC markets is your platform. We have both the platforms. If you want, you can have that. You can buy long term and keep it, both in derivatives and for ownership through interactive. That can be done. Somebody else asked me about how to open the account. See, opening the account, you can talk to your relationship managers. Just the documentation needed. It takes 1 or 2 days mostly to get the account open. And somebody is asking about the one-on-one session. So for one-on-one session, please talk to your relationship manager. I'm available. I just have to schedule my day because I'm doing hour-on-hour based training. So just talk to your relationship manager and we'll have a hour-long session where we can discuss about the platform as well. Right? So until there are any more questions, I would like to take your leave. Once again, please review us on Google and leave your views over there. It is really important for us to have your feedback. And thank you so much once again for joining. I wish a good health. Please stay safe. I'm sure not many of you are staying at home right now, but please, if not staying at home, stay safe. It is really important. Stay safe and stay invested also. And I hope once the offices are open, pandemic is over, we can always meet in the office for a cup of tea without any sanitizers and masks. So once again, thank you so much. Take a very good care of yourself, and we'll meet soon again on Zoom, preferably for a one-on-one session, and we'll talk again. Thank you so much, guys. Take care.